Better System Trader, episode 25.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 25, and I'm your host, Andrew Swanscott. This episode is sponsored by InvestorQuant. InvestorQuant provides quantitative research tools and services for self-directed traders and investors. Their actionable data is available on demand via an intuitive graphical interface for trading intraday, overnight, and multi-day timeframes across thousands of equities, ETFs, futures, and commodity markets. Join the InvestorQuant team and the keynote speaker Dr Brett Steenbarger for an engaging two-day conference with 20 sessions at QuantFest 2015. Presentations will cover many quantitative strategies and include numerous real-world topics such as managing drawdowns, cloud-based trading, and creating rules-based trading plans. Simply click the banner in the show notes, bettersystemtrader.com/25 to learn more. Now onto the show. This week's guest is Dr. Brett Steenbarger, a trader, psychologist, and trading coach who's been actively involved in the financial markets since the late 1970s. Brett has an interest in using historical patterns in markets to find a trading edge and has created a number of unique measures of market trend, momentum, and institutional activity designed for short-term trading, publishing these measures and strategies on his popular Trader Feed blog. He's also a regular contributor for Forbes and consults for hedge funds, investment banks, and proprietary trading firms. He's the author of a number of popular trading books, including The Psychology of Trading, Enhancing Trader Performance, The Daily Trading Coach, and his new book, Trading Psychology 2.0, which is due for release late September 2015. In this episode with Brett, we discuss creativity, static thinking, and why it's important to have unique ideas for trading success. We also cover tips to increase our creativity, why traditional trading rules need to be updated, plus the challenges of day trading and how to overcome them. We also have a bunch of listener questions covering a wide variety of trading topics, so listen out for those. Anyway, let's get to it. I hope you enjoyed the chat with Dr. Brett Steenbarger. Thanks for joining us today, Brett. Now, I'm sure most people who've been trading for a while know who you are, but for those who maybe aren't so sure, can you please give us a little bit of background on yourself?
Sure, Swanee. Thanks for having me on the podcast. I'm a psychologist by training and have worked with professional traders since 2004. My background in financial markets, as far as being a trader, goes back to the late 1970s. So I have always had these parallel interests in psychology and in trading financial markets. But it wasn't until around 2000 that I started really putting those together, wrote my first book called The Psychology of Trading, and out of that book began working full-time with traders in Chicago who were market makers in the electronic futures. And so I learned quite a bit about day trading, and later moved on and worked with investment banks and hedge funds and learned quite a bit about market making and portfolio management. Right now, I work with several different hedge funds as a performance coach to help individual money managers and their teams do better at what they're good at.
So as you mentioned, you've worked with a lot of traders, especially in trading firms and hedge funds. So what are some of the typical issues you see with traders at that type of level?
Well, there are a few issues. I would put it in three categories. First, you have issues that come up when traders go into drawdown. They're losing money, they may become frustrated, they may need to adapt to markets, they may become risk averse, but losing money can affect their thought process, their emotions, and their decision making. And so I help them maintain their best practices in trading, even during times of setback. That would be the first set of issues. The second set of issues are really applicable to traders who are doing quite well. Many times traders are successful, but aren't very aware of the nature of their success, what their strengths are, what they do well in markets. And so I try to acquaint them with their strengths and help them become more consistent in applying their strengths so that they can extend their profitability. Many of the money managers I work with are interested in growing out teams, and so I will help them extend their business that way. So that's the second set of issues. The third set are when personal issues outside of financial markets influence decision making. Maybe someone is going through financial difficulties or health problems. Maybe there are difficulties in the family or relationship problems. All of those can be tremendously distracting for traders and color decision making. So my role as a psychologist is to help them resolve the issues in their personal life so that they can properly focus on their trading.
Okay, thanks, Brett. I think we'll actually be touching on some of those a little bit later today. But what I'd like to ask you is, looking at the other side of the coin there, what do you find is a consistent aspect of successful traders that actually made them successful?
Well, at most of the firms where I've worked, we've done some research about what makes traders successful. And there's a combination of factors. If I had to distill the essence of success, I would say that there are three important components. One is that every successful trader I've met is doing something unique. You don't find generic super successful traders. It's like that in the business world. If someone starts a Me Too business, just copying what others are doing, if I just open a pizza shop on the corner and try to copy what everyone's doing, there's no way that's going to be a very successful business. I'm not doing anything distinctive to win in the marketplace. Similarly, there are traders who hope that they can trade patterns that they read about in books or that they hear about from others, and that they will be successful simply by copying others. It does not happen. The traders I work with who are very successful, in a sense, are playing a different game. They figure out something unique, some unique set of relationships in markets, some unique way of looking at markets, and they're able to leverage that unique perspective into some objective edge in the markets they're trading. So that's the first aspect. The second aspect pertains to personality strengths. I think the idea that there is a personality pattern that accounts for trading success is not correct. There are successful traders with many different personality patterns. But as Jack Schwager points out in the Market Wizards books, the very successful traders find a way to leverage their personality strengths to how they engage markets. And so we see that the traders who are very successful are uniquely able to draw upon some set of personality strengths that they have. The third set of factors are cognitive strengths. And I think these are really the underappreciated factors in trader success. How people process information. Our thinking style helps determine how we think about markets and how we process information about markets and ultimately how we make decisions in markets. And once again, we find that people have unique cognitive strengths, and the successful traders are ones who can make unique use of the strengths that they have as information processors.
Okay, then. Thanks. So your new book, Trading Psychology 2.0, suggests that the old approaches to trading, for example, plan your trades, trade your plan, controlling your emotions, following your rules, etc., they need to be adapted or perhaps updated. Can you explain why you think that is the case and what the new approach would look like?
Yes, well, the Trading Psychology 2.0 is my most recent book. It's coming out at the end of September of this year, 2015. And I titled it that way because I felt there was an increasing body of research in psychology describing the determinants of successful performance that traditional views of trading psychology simply were not taking into account. One of the things I've noticed among successful traders is that they are unusually able to adapt to changing market conditions. Markets are not constant over time. They change in their trends, they change in their volatility, correlations among asset classes change, and successful traders have an ability to adapt to those shifts in markets. So the idea of simply trading with discipline and robotically controlling your emotions and trading your edge really assumes that markets are static.
Yeah.
When markets change and people, in the name of discipline, keep doing the same thing, they end up losing and losing and losing with consistency. So that this whole idea of controlling your emotions and trading with discipline ends up becoming a formula for staying static in ever-changing markets. So that's where creativity is important. That's where adaptability is important. That's where open-mindedness is important. Because markets are always changing, we always have to adapt.
Yeah, sure. So before we get into creativity, I'd just like to ask, so in your book, you say that a trader needs to be more like an entrepreneur. Can you explain what particular aspects of being an entrepreneur actually apply well to the trading arena?
Well, I think there are a number of ways. And for a professional trader, trading is their business. They're running their business. And just like any entrepreneur, they have a marketplace and they have to figure out how to win in that marketplace. But an entrepreneur knows that markets are dynamic. So that if I'm in the technology sector and I'm trying to develop and market a better smartphone, I have to realize that what consumers want today could be very different from what they demand tomorrow. Mm-hmm. So I need a way to understand my marketplace and adapt to those changes. Otherwise, I'm going to be making BlackBerry phones at a time when iPhones become the rage. So that, again, that idea of dynamic markets and adaptability, I think, is a common theme between entrepreneurs and traders.
Yeah, I think most traders understand that they need to have a unique edge in the market. But why do you think so many just wind up copying everyone else or being part of the herd?
See, yeah, in the spirit of Ayn Rand, I'll encourage you to check your premises. I don't think traders need a unique edge in the market. That's the kind of static thinking that hurts them. Many traders assume once they find a unique edge in the market that it will last for all time, and it just doesn't happen. It doesn't happen in the commercial marketplace for the entrepreneur. It doesn't happen for the trader. Yes, you need unique edges, but because markets are changing, you always need to renew your edge. Your edge is always going to be changing. So you need a process for changing your process. You need a process for developing new sources of edge. And I think that's a big piece that traders miss. And both systems traders and discretionary traders, they hope to find their edge and they will win forever. It doesn't happen. But to get back to your question, you make a good point, and that is that people are sometimes averse to effort and to find unique edges in marketplaces. Whether you're an entrepreneur or whether you're a trader is not easy. And so I think there is a certain hope, both among entrepreneurs and traders, that they can get rich quick, that this will be a path to easy wealth. And in a sense, they're looking to trading as a way of not having to work hard rather than being so attracted to financial markets and so driven to understand them that they work extra hard to find their sources of edge.
Okay. So there was a post on your Trader Feed website that discussed the two different trading brains, the intellectual and the social. Can you explain what that is and the implications to trading and creativity?
Yes. Well, as I mentioned before, people have very different ways of processing information. And one of the differences that we see among traders is that some process information in a way that we could call intellectually. I guess a better word would be analytically. So some traders analyze markets. They dig deep statistically. They read research reports. They're exploring for relationships. Other traders process information in a much more interpersonal and social framework. So they discuss ideas with other traders, either on a trading floor or in chat format. But they benefit from hearing themselves talk, hearing others talk, having others respond to what they have to say. And so they are processing information in a rather dynamic social fashion. People have different strengths as far as processing information. Not everyone is an analyst and an analyzer, and not everyone is wired socially. And so once again, it's this idea of drawing upon your strengths as an information processor to find your best results. Creativity comes into it when we are able to draw upon our information processing strengths in a way that allows us to look at the world in a new fashion.
Okay. If we can just talk a little bit more about the importance of creativity. I know you've already touched on it a little, but there was a really a nice story in your book where you mentioned a study of two groups of artists, and they were given a variety of objects to arrange and to sketch. And I thought the results of that study provided quite an excellent insight into the importance of creativity and how it relates to trading. Would you mind sharing that story?
Yes. And actually, there have been a number of these studies. In the one that you're mentioning, one group of artists, they were given a certain amount of time to think about or to plan a sketch, an art product. And one group made many different sketches. They didn't think about the composition for very long, but they made many different sketches, threw away a number of them, tried again, threw more away, and then came up with a final version. Another group spent more time organizing the composition and thinking about it and planning it and arranging, and spent relatively little time on the final sketching process. So one group was doing a kind of trial and error, and another group was really more in a brainstorming mode. And they ended up with the paintings that were judged by objective judges to be more creative. It gets at the issue of what's called problem finding in creativity. People who are successfully creative are very good at identifying problems to solve. In other words, they ask better questions. And so they spend a lot of time thinking about the world and relationships between things, and they hit upon an interesting question and then work intensively on that, rather than work in a more scattershot fashion on problems that may have low yield. So it becomes important when we're looking at financial markets, once again, to look at them through unique lenses and to be able to see things that other people may not be looking at. That allows us to define unique problems, which is the first step in finding unique solutions. So here's a good example. A lot of people look at volatility in markets. I personally trade the S&P futures. So, there are many ways we can look at volatility. We can look at realized volatility, the historical price movement over time. We can look at implied volatility from options markets, such as the VIX. It occurred to me that volume and volatility are very highly correlated. In fact, in the past year, the correlation was about 0.82 between volume in the SPY ETF and volatility, daily volatility. And so I thought, well, what if we think of volatility in a different way? What if we think of volatility as the amount of movement per unit of volume? So now we're looking at volatility as something separate from market participation, from volume. Statistically, we're partialing out volume and creating a pure measure of volatility. So I created charts with volume bars and started looking at the volatility, the realized volatility of those bars. And it turned out that this pure measure of volatility had some real value in anticipating future price movement. So it's a good example of how spending a lot of time thinking about volatility, just like spending a lot of time thinking about one's painting composition, ends up asking a different question and maybe a better question, which then paves the way potentially for a better answer. That's what I see among successful traders. They look at markets in unique ways. They're able to ask different questions and thereby come up with different answers and unique sources of edge. That's what creativity is all about.
Right. So it sounds like you're saying that creativity is not just something that you're either born with or without, but there are actually steps that you can take to improve our creativity, like asking better questions.
That's a great point, that the research suggests that creativity can be learned. And I do believe that in successful mentoring, part of what's learned is that creative process. You learn to think like and see the world through the eyes of a successful mentor.
I've also noticed that, and I'm sure others have as well, that I often come up with ideas when I'm not even thinking about a specific task or problem. What's happening there, and can that be harnessed somehow?
Another great point that you make, and that is well documented in the psychological research on creativity. The way I think about it is that the successfully creative person spends a lot of time thinking about things, analyzing things, looking at different patterns and relationships of patterns, and they're looking into the different markets, what the markets are doing, and all of that is a process of analysis, getting inside of something. It's almost like looking at the world through a microscope and seeing detail. The creative insight, however, comes after that intensive immersion in data and observations. It's often when people step back, as you say, that they end up taking what they have analyzed and actually synthesizing it, putting it together into a new picture. Mm. And this is why so many of our insights will come at seemingly random times when we're taking a walk or taking a shower, because we are subconsciously synthesizing what we have been analyzing. We are taking the pieces of the puzzle that we have looked at through the microscope, and now we're looking through a telescope and we're seeing a bigger picture. If there isn't that intensive immersion in observations, there's nothing to synthesize. But also, if we keep our nose in the microscope, so to speak, we never zoom out and get that bigger picture. Creativity is a kind of 1-2 process of analyzing, seeing the pieces, and then stepping back and seeing a new, bigger picture.
So it sounds like also that there's a lifestyle impact on creativity. So you mentioned that, it can come to you when you're walking or when you're relaxing. What other things can we do to improve creativity through our lifestyle choices?
Well, it's interesting that you tie lifestyle choices to creativity. I think there's merit to that observation. The synthesis part, seeing the bigger picture, really requires an open mind. And if you are constantly watching price action, or if you are working from one task to another task to another task, you never really have the kind of calm focus that seems to be helpful for generating that creative synthesis. That's why I think it's often during relatively unstructured free time that we come up with our insights. If we don't have that relatively unstructured free time, we clutter our minds and we never get to that point of assembling a larger picture. So there are techniques, even such as meditation, that help put us into a calm, focused state of mind where we're more likely to assemble the pieces of the puzzle.
That's interesting. I never really considered the importance of the synthesis step there. So that's great to highlight that.
Yes, and I think what happens is traders work hard but don't work smart. They do the analyzing. They're looking at charts. They're looking at data. They're just they got their nose right in the screen. They have their ears right in the conversations, and they're never stepping back and seeing a bigger picture or pattern. And as a result, they never see the world in new and different ways because they never achieve that creative synthesis.
Yeah, and I thought there was another great idea in your book about using daily productivity quotas to turn creativity into a habit. Would you mind expanding on that a little bit?
Yes, there's good research about how people change in general, and again, it's challenging the notion that people change through the imposition of quote unquote discipline. In fact, discipline is a rather poor means to make changes in life, as we find out from our New Year's resolutions. The way we want to change is by turning desired behaviors into habit patterns, because habit patterns are things we do automatically. I get up in the morning and I have the same routine every morning. I go downstairs and I feed my cats and I wash up and I brush my teeth and so forth and so on. And it would feel strange if I didn't do that. I don't have to motivate myself. I don't need discipline to do those things. So you want to turn a desired behavior into that kind of habit. Creativity is simply an example of that. We can structure our time to think more creatively, to structure our time looking at the pieces of the puzzle, to structure our synthesis time, to look at bigger pictures, and turn that into a daily routine. One creativity technique that I particularly love is called brainwriting. Brainwriting is the writing equivalent of brainstorming. What you're doing is, after you have immersed yourself in observations, maybe you've looked at many charts, you've looked at lots of data, you've read up on all the news and geopolitical events, you then write, stream of consciousness style, everything that you have observed and all the thoughts that have been triggered by your observations. You don't censor what you've written. You don't worry about the grammar. You don't change words or phrases. You don't pause and think about it. You just write, stream of consciousness. And sure enough, you'll be writing something and that will trigger a new thought, and you'll write something about that and that will trigger a new thought. And pretty soon you're brainstorming on paper or on a keyboard. And that can become part of a daily journal. That can become part of a daily creativity routine. And so making it part of a routine that way, of course, is creating a habit and making it part of our trading process.
Yeah, that's a great tip there. Thank you, Brett. So before we move on to listener questions, I'd just like to spend a few minutes talking about day trading because I think a lot of people find it a difficult time frame to trade in. And well, you're a day trader, so I guess firstly, how or why did you get started in that?
Yes, it's a good question, and I really started in a sense by happenstance. When I very first started trading, I was trading on a longer time frame, even longer than swing, and was making short-term investments in individual companies, individual stocks. And what I found was that it didn't play to my strengths. That I have some strengths in terms of pattern recognition. And the faster the trading, the shorter the time frame of trading, the shorter the holding period, the more pattern recognition becomes important to trading success. And so I found that I could recognize patterns in markets in real time, and that was a different skill than trying to analyze companies and which ones would have the best earnings and would be most likely to go up in price. So I began trading on the shorter time frame and became very interested in higher frequency measures of buying and selling as ways of understanding who was dominating the marketplace. And that approach really has stuck with me over the years. There are different indicators I look at to get a sense of buying flows and selling flows, and looking at when the buying is waning, when the selling is increasing, and using those shifts to place my orders. So that's how I got involved in day trading. I do think day trading is challenging because those flows really changed, not just day to day, but even within the day. And so we see different volume patterns early in the day versus middle of the day versus end of day. There are different market participants. I work with people who execute in the markets. We're talking about hedge funds that are managing billions of dollars. And I see the way they execute trades. And there are times where the institutions are more active in the marketplace and times where they're not. There are times when the market makers are more dominant. And so there are many shifts during the day. And if you try to trade a static set of patterns and don't adapt to who is in the markets, I think day trading can be very difficult.
Yeah, okay. So I think for those starting out or even those that are looking to improve their day trading performance, what would your advice be?
Um, my favorite initial exercise for improving your performance is to create a catalog and detail all of your successful trades. Take a look at what you're doing right. It's a bit counterintuitive. Traders tend to focus on their weaknesses. When you look at their journals, they're always writing about how they messed up this trade or what they did wrong or how they lapsed in their discipline. But you really want to study your best trading, because your best trading over time is going to reflect some of those strengths. Cognitive strengths, personality strengths, ways of looking at markets. So you want to reverse engineer your successes and study yourself when you're trading well, because your consistent success will come from identifying the skills, the talents, the strengths that you do have, and then leveraging those so that you can be more consistent in applying them. So I think if every trader took their 20 best trades and their 20 worst trades over a recent time frame and contrasted what they're doing in their best trading times and what they're doing in their worst trading times, they would learn a lot and could go quite a long way in coaching themselves.
Okay, thank you very much, Brett. I'd just like to move on to some listener questions now.
Sure.
Okay, the first one is from Ola. Ola asks, you've worked a lot with diffusion indices to gauge the market. How would you suggest these be used in trading? What timeframes do they work best on? And would they be best used as market filters?
Wow, it's a huge issue, and partly, obviously, the answer is going to depend on the time frame of the trader. I do think that those kind of indices can be helpful intraday, and I've seen them helpful on a multi-day basis. So I don't think there is one particular time frame where they are uniquely useful. I think that you want to adapt them to the trading that you already do well. But a good example would be, let's say you're trading currencies and you notice strength in the relationship of the euro to the US dollar. Well, the euro is up versus the dollar, but what does that really mean? Does that mean that the euro is strong, or does it mean that the dollar is weak, or both? What we would want to do is look at many other crosses. So we create a diffusion index, or we create what I would call a breadth index, and we look at the euro versus many different major crosses, and we look at the US dollar versus many crosses. And what we can see is that there may be unique weakness, let's say, in the US dollar. And perhaps there's unique weakness in the US dollar, as at the moment that I'm talking, because Federal Reserve policy is such that they decide to not raise interest rates. Now, we can then look at when the US dollar is quite weak against a large basket of currencies and say, okay, well, in the past, when this has occurred, what has tended to be the forward movement of the US dollar? And so we can create historical studies that may illuminate patterns, some of which may be significant and could be tradable. That would be a good example of how I would use a breadth index. Another way would be with stocks and looking at the proportion of stocks that are trading above certain moving averages. So what percentage of S&P 500 stocks are trading above their 5-day moving average? It turns out that captures some short-term mean reversion patterns. And by looking at strength and weakness across all 500 stocks, rather than just in the index itself, we gain some level of detail and information in the marketplace.
Okay. Thanks, Brett.
Sure.
The next question is from Claude. Claude's been trading for around 15 years and had ups and downs. The question, as a non-institutional trader, I find that it's extremely hard to formalize a well-defined edge. Is a lasting edge a myth? Do you have any advice on how to formalize an edge?
Well, there are two questions here, right? I mean, one is how do you formalize an edge, and then are there lasting edges? And what I would say is that there are persistent edges, but because markets are always changing, as we talked about before, any particular edge may wax and wane. Some of the best system developers I've worked with have multiple systems that work in different regimes, different volatility regimes, different correlation regimes, different directional regimes. And some of their systems turn on when we get into one regime, and they turn off when we get into another regime. So you always have you have a system that trades the systems. You have a system that turns on and off the different systems to adapt to changing market conditions. And so an edge may be relevant at one point in time, not at another point in time, and then could be relevant at a future point in time. So it's not a matter of yes, no, is it lasting, not lasting. But if you're looking for one edge that will last in perpetuity, I don't see that in the business world, and I don't see that in the financial world. How do you codify your edge? How do you identify or formalize your edge? Clearly, you have to do that with back testing, some kind of historical analysis. If you're a discretionary trader, you're going to do it through your track record, and by looking over time at whether your decisions have a positive expected return, or you're going to look historically at patterns in markets that you test systematically, in sample, out of sample, in real time, and so forth. So you formalize your edge by studying the historical performance.
Yep. Thanks, Brett. So I'll jump to a question from Marcus. He said, Larry Williams said in an interview on this podcast, actually, that you don't trade the market, you trade your personality. So with this in mind, and you yourself being a successful futures day trader, what traits in your personality help you to succeed intraday where others would fail?
Yes, I know Larry and respect him, and I think there's wisdom in what he says, and it really fits with some of the things Jack Schwager talks about. I would amend the way he said it. I would say people trade the market through their personality. If you don't have an objective edge in the marketplace, you're not going to make money, period. You have to be trading some patterns, some set of relationships that objectively exist in markets. It's not that anyone willy-nilly could trade according to what they feel and how they think and will make money. That doesn't happen. And that's not what Larry was talking about. But again, it's this idea of leveraging our strengths so that we draw upon what we are good at in how we engage markets. The work I've done and the work I've seen done on successful trading suggests that personality is probably more predictive of trading style than trading success per se. So in my own case, I mentioned that I'm good at quick pattern recognition. So that becomes an important part of my trading. I also, I'm pretty good at historically analyzing patterns in markets. And so I use those historical studies to create a hypothesis. I'm not a systematic trader. I would be what you would call a hybrid trader. So I use patterns that I study historically to generate hypotheses, and then I look to the tape action, which is the pattern recognition short term, to see if those hypotheses are being confirmed or disconfirmed. And so it's at the intersection of generating the hypothesis and seeing what is setting up in real time that I find I'm best able to engage markets.
Okay, thanks, Brett. Now, I've got some questions here from Matthew. He's got quite a few and we're kind of running tight on time, so I'll just ask the first one. How does a day trader, or I guess any trader, obey his rules on each trade as to taking the stop loss and profit targets as set? What steps can he practice in order that he obeys the rules similarly to how he would when he drives a car?
Well, that's a nice little piece of insight there, comparing the rules of driving to the rules of trading. So when I'm driving my car and there is a rule about driving in my country on the right side of the road and driving at a certain speed, it's not like I feel particular temptation to vary from the rules, to veer from the rules. And oh shit, I'd love to drive on the left side of the road today. Let's just try it just one time. That doesn't happen. The rules have a force of reality. Why? Because I'm concretely aware of the consequences of not obeying those rules. If I go over the speed limit significantly, I could get arrested. I could lose my driver's license. If I drive over the speed limit on wet surfaces or snowy surfaces, I could get into an accident. If I drive in the wrong side of the road, I could run headlong into an oncoming vehicle. So I'm very aware. So the way we learn to follow our rules is through conscious, mindful awareness of consequences. And by making those rules as automatic for trading as they are for driving, so that I'm so accustomed to following the rules in driving, once again, it's become a habit pattern. It's not something I think about. I don't sit there as I start my car and think, okay, let's rehearse driving on the right side of the road. It's not that at all. It's a habit pattern. Yeah. So you want it to be that way with trading, that you are practicing trading in simulation, practicing with small size, and following the rules becomes an ingrained, internalized habit pattern that then you don't have to wrestle with.
Okay. Thanks, Brett. A question from Mike. How different from a psychological perspective is systematic trading when compared to discretionary? Do you think one style of trading is psychologically easier than another?
Great question. And the answer is yes. One type of trading is easier than the other for certain people. And once again, it's back to that issue of strengths. There's no question that to the degree that you can formalize the rules and to the degree that you can have your system, the computer, execute for you, you are taking discretion out of trading. You're taking a certain degree of subjective decision making out of the equation. You're taking a certain degree of emotion out of the trading. And for some people, that is extremely helpful, particularly people I found who are relatively introverted, who are relatively analytical in their style of processing information. That can be very, very useful. Other people really do benefit from having a feel for the market. Their decision-making style is more intuitive than analytical. I saw that with the day traders I worked with in Chicago. And so if they tried to trade mechanically, they would lose their feel for markets altogether and would not succeed. So once again, it's back to Larry Williams' observation. There has to be a fit between your personality, your cognitive style, and how you engage markets. And that could work very well for systematic traders. And for different people, it can work very well in a discretionary trading style.
Okay. And the next question is from Raul. Raul asks, acceptance commitment therapy is becoming increasingly popular for psychological conditioning in the trading community. Do you believe this to be a legitimate form of therapy? And if so, do you believe it has any advantage over other forms of conditioning like NLP or hypnosis for dealing with the psychological problems faced by traders?
Yeah, it's a good question. And there is a large outcome literature in psychotherapy about which techniques are effective. And my understanding is that the acceptance and commitment therapy, the ACT approach, does have a growing literature of success with a number of problems. And it is an accepted form of behavior change. It's roughly categorized as a type of cognitive behavioral therapy. And there are many cognitive behavioral therapies that have been found to be effective. So yes, I think it is legitimate. Whether it would be more effective than, let's say, hypnosis for one problem or another problem, the research is more equivocal about that. In therapy itself, the best predictor of outcomes ends up being the quality of the relationship between the therapist and the client, not the specific approach that's used. So I would be hesitant to say across all problems and people, acceptance and commitment therapy is better than some other form of therapy that has been validated in the outcome literature. That being said, the whole notion of acceptance, that you accept problems, you don't fight against them, you use them as prods or stimuli for learning, I think is a powerful framework and very relevant to traders. When we have a drawdown, how do we deal with that? One way of dealing with it is by accepting it, that we've done something has gone wrong. We've either had the wrong idea about the market or we've had the right idea and we've traded it wrong. But in either case, there's something we can learn from the drawdown, from the loss. And so by accepting the drawdown and then by actively trying to learn from it, we take an approach that could be frustrated and make us impulsive, and we turn it into a learning experience that ends up being constructive. So I like the notion of acceptance when working with traders.
Yeah, that's really interesting. Thanks, Brett. One final listener question before we wrap up today. It's from Jerry, and Jerry is an experienced retail investor who now wants to turn pro. So his question is around how does he go about constructing a curriculum to do so, and what approach can he take to assemble a good collection of materials, training, or mentors?
Wow, that's a very broad question, and frankly, I would want to do that before turning pro,
Mm.
right? So develop the curriculum, find the mentorship, benefit from the curriculum, benefit from the mentorship, then go pro. I have met with people who have gone pro, gone full time to trading prematurely, and it ends up creating a lot of stresses for people and their families in some cases. I think that you want to use your own trading, whether it's paper trading, simulated trading, or live trading, as an important part of your curriculum. Like I said before, you want to learn from your mistakes and identify what you're doing wrong and identify corrective measures. But you also want to focus on what you're doing well, what you're doing right, and solidify your strengths. So you're constantly studying yourself and your performance and using that as a central part of your curriculum. There's lots of good research about the value of mentoring. And I think if you're able to join a trading firm and work with a more senior mentor, someone who already is successful in markets, who can observe you and give you feedback, there is tremendous benefit in that. Not everyone can do that, and it's not for everyone, but I think that learning from other successful people can be very useful. And sometimes there are resources online where you can connect with successful traders and observe how they're thinking about markets and pick up some useful information that way.
Okay, thanks, Brett. So we'll just start wrapping up now with a couple of quick closing questions. What's the biggest lesson you've learned through trading?
The biggest lesson I've learned from trading is that it's important to have something in your life more important than trading.
That's interesting.
Yes, because I've been involved in hiring at a lot of the firms where I've worked, right? And so people come to me and they're looking for a job as a trader. And so what do they say? They have a passion for trading, and trading is the most important thing in their life, and so forth and so on. And I know that's someone who's going to blow up, because if you don't have anything more important in your life than trading, then your feelings of self-worth and your feelings of success and failure will rise and fall with your P&L. You have to have something more important than your P&L that gives you stability so that you can weather the inevitable ups and downs of trading. So it's important to have relationships that are more important than trading. It's important to have personal interests and commitments, whether those be of a family nature, a spiritual nature, with friends. But it's important to have things in life that sustain you through the lean times of trading. It's important to have capital to sustain you through the lean times of trading. If you're all in and you don't have other things to sustain you, you won't have the longevity and you won't make trading a career.
Great advice. Thanks, Brett. And a final question, do you have a favorite book?
A favorite book? Good question. I have a few favorite books.
Well, you can mention a few.
Yeah. Well, I'll mention one, and it certainly was a book that influenced me quite a bit, and that was the novel The Fountainhead by Ayn Rand. And the reason that it influenced me was that it focused on a heroic vision of people, what people can be at their best. And I found that inspiring. And as a person training to become a psychologist, I found that inspiring because it helped lead me to want to work with healthy people and helping them grow, as opposed to working with people who have diagnosed mental illnesses and helping them recover. And in working with traders, I find that positive focus, that focus on the ideal, to be very, very helpful, but also inspiring during those times of drawdown. So the fountainhead really shaped the nature of my interest in psychology, and I think that shows through in my own books, in my way of understanding that and applying it.
Sounds like a great book. Thanks for the recommendation.
Sure.
So thanks so much for chatting with us today, Brett. Is there anything else you'd like to mention before we wrap it up today?
I would wrap up by saying that, echoing something I wrote in my most recent book, at some times, maybe not often enough, but at some times, you are a great trader. You trade very, very well. You see things, you understand things. At times, you are the trader that you ultimately want to be. The whole key is to figure out who you are, how you operate when you are that good trader, when you are at your best. If you can reverse engineer that, if you can figure out who you are when you are successful, you've got a great opportunity to make that success more consistent in your life.
Yeah, that's great advice. Thank you, Brett. Actually, I forgot one question. What's the best way for listeners to get in touch with you?
Well, I'm active in Twitter, and so people can feel free to tweet me at Steenbab, Steenbab.
Yep. And you also publish a lot of great content on traderfeed.com. So I recommend everyone head over to that and have a look.
Yeah. And I also write a blog for Forbes, the financial magazine. So yes, I'm out there in social media land, but the Twitter at Steenbab, Steenbab, is a great way to access me.
Yeah, okay, great. I'll put links for those in the show notes so everyone can find you easily. Well, thanks a lot for spending time with us today, Brett, sharing some valuable insights into trading and the importance of creativity. I'm sure there are a lot of traders out there that will find the chat today invaluable. So
good.
Thanks again, and I wish you all the best for the future.
Well, same here, Swanee. You've done a great job in assembling these podcasts, and you really have a list of good contributors, and I'm honored to be one of them. Thank you very much.
Well, thank you very much, Brett. All the best.
Okay.
Cheers.
All right. Bye.
Bye. What a great chat with Brett this week. Here are a couple of key takeaway points I picked up from Brett. Firstly, it's important to see the markets through unique lenses. Through Brett's work coaching other traders, he's identified that successful traders really look at the market in unique ways. They have a unique perspective that comes out of asking different questions and therefore finding different answers to generate unique sorts of edge. Creativity plays a big part in this process. My second point was the importance of downtime. I'm sure we all realise that we need to take time away from the markets to reset, but I never realised that our brains need time to synthesise all the information we've collected about the market, and that it's often during unstructured free time that we come up with our insights. Creativity is a process of analysing the individual pieces in detail and then stepping back to see the bigger picture. If we never step back, then we're really missing out on a huge piece of potential there. The third point was creativity can be learned, and Brett provided a number of techniques to increasing creativity in our chat today. But as Brett mentioned, he has a new book called Trading Psychology 2.0 being released in late September or maybe early October, 2015. That book also has a number of other techniques to increasing creativity, so I recommend that you go and check that one out once it's available. It's a great book. Now, if you'd like more info on this week's episode, including a video on trading performance and some other cool stuff, head over to the show notes, bettersystemtrader.com/25, and you can get all the details there. I'd also like to say a huge thanks to all the listeners that submitted questions for Brett this week. Now, as I mentioned at the start of the show, Brett will be keynote speaker at QuantFest 2015, which is a 2-day conference being hosted by InvestorQuant. Presentations will cover many quantitative strategies and include numerous real-world topics such as managing drawdowns, cloud-based trading, and creating rules-based trading plans. They've got a great program lined up, so make sure you head over to the show notes page at bettersystemtrader.com/25 and click the link to get more info on QuantFest 2015. Anyway, that's it for this week. I hope you enjoyed the chat with Brett, and thanks for listening to Better System Trader. Catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.